Good morning. Welcome to IOOGO Accounting webinar. We are so glad you're able to join us. And thank you to Capital Factory for hosting us. This isn't our first webinar. We've hosted some in the past and have helped a lot of Capital Factory startups and other small businesses. And we really hope that you benefit today just as much as they did.
Yeah, hello everyone. We're very excited to be here today and really looking forward to sharing once again with everyone here in the audience. We used to do this webinars live, and well, we all know what happened. So we're using this very cool technology, and this is what we're here for, right? We're most of us are technology companies, so we gotta keep the show going. So good morning, everyone. We're gonna try to make this as fun as possible, as fun as you can make tax and accounting. But why don't we introduce ourselves, Christy?
Sure thing. So I'm Christy Alvieto, first as a tax accountant, secondly COO for IOOGO.
And do we have the slides?
Is it
there
not?
We go.
Okay,
All
sorry,
right.
the delay.
Cool. And I am Josh Alballero, and I am the CEO of IOOGO. We are a tax and accounting technology company, and we'll talk about us here in a couple of minutes. About the company. I have been in tax and accounting for almost 20 years now, and in all kinds of levels. And as I said before, I'm very happy to be here and help you guys out. Those of you who are in the beginning stages, in the infancy stages of your startup, or some of you who are already in year 2, year 3, you already raised some capital, you already got some revenue going, and you're just trying to make sure that you are setting the right structure for your business. Welcome. And so let's talk a little bit about our company, Christy.
Yes. So about IOOGO, we are a tax and accounting technology company. So we've got a team of CPAs, accountants, tax professionals. Really depending on the business needs is who we'll assign to help the business out. But in the center of all of the team is our proprietary technology. And that technology really allows our team to operate efficiently without compromising any quality. And that gives them more time to really focus on the individualized needs of startups and small businesses that have already been established, which, it's not your traditional CPA. And on the flip side, we're also not full-on robot accounting. So there is that personalized touch with that technology that drives everything.
I think you put it the best way, right? It's we're not your traditional mom and pop CPA, even though we have some very highly qualified CPAs in the firm, but we love technology. So this is where experience meet the robots, right? And we're able to give you that quality of work that you deserve. And to be honest, right, we looked at, over the past few years, we have looked at how the accounting and tax technology is growing. But unfortunately, the state and local and federal agencies haven't, catch up to that technology. So you still need the experienced CPA for a lot of things. You still need your tax pro. You still need your accountants in the process. And let's face it, right? You did not open this business to become an accountant, to be your own bookkeeper, right? So it's important for us to be able to bring you not just the service, but also the necessary care that your startup needs, as you grow.
Yep. So we want to tell you a little bit who we service so far, so you get an idea of the type of companies we've been helping. And you might recognize a few of them from Capital Factory. First one I want to talk about is Line Dance AI. They've been with us for a few years now, and they are in the artificial intelligence space, doing really cool things there. We're also working with Simbury. They're based out of Austin, and they have Uberized pool cleaning, which is very unique, and also why they're a great fit for the community.
One of my favorite ones, you've probably seen them around because they've been around for a while. Capital Factory, Startup of the Year, Founder of the Year, I believe as well. Roberto Inetti, RoboAmp, really cool technology. We are a client. We've been together for a while, and you know, it's really cool to see. To be able to work together, right, in the different needs that we have. So, you know, really love the RoboAmp technology. Another one of my favorites. I'm not supposed to have favorites, but I do, just because of the social mission that they carry. Miss Izzy International. They do a lot of a lot of branding, and it's they do a lot of work with minorities, and you know, it's an e-commerce company that it's growing very rapidly. You could, you know, follow them, so you can see them, you know, see their growth on all social media platforms.
Low Waste Home is another social mission driven company. So I always like that as well. And they are focused on basically eliminating waste from wastelands, you know, not using those products that you end up throwing away, but instead getting those products for your home and for your personal that are healthy for the environment. And they are on the influencer marketing side.
And of course, Capital Factory's most favorite attorney, corporate attorney, Kyle Kurtz, a good friend of ours as well. He's also a client. You know, if you go into Slack and you say, hey, I need some advice on this, or I need a recommendation of an attorney, you know, within minutes you're going to hear the name Kyle Kurtz, right? And he does a really good job. Great attorney. He's based off Dallas, but he works with Austin a lot, just like we do. So just to give you an idea of who our clients are, you know, and you know, the experience that we bring, not just with the technology side, but also with the personal touch.
Yeah. So here's what we're going to be focused on today. We want to talk about accounting for purposes of tax filing. I want to talk about when does it make sense to engage support for that tax and accounting as your business grows. And then again, with growth, you're going to either be putting yourself on salary, you're going to be hiring employees. And so there's payroll taxes that come with that. And then income taxes as you become profitable. But to make those income taxes a little bit less harsh on the wallet, there's credits and deductions that we'll discuss. And then finally, at the end, we'll leave you with some resources. If you have questions about anything that we weren't able to go in depth into today, we are limited on time. We'll have those for you at the end. And also, please take advantage of the chat. We don't have an official Q&A slide, so we'll be keeping an eye out for questions as we're talking. And we'd like to answer those as we go along versus waiting for the end. So please don't be shy.
Yeah, so let's dive into it, and I'm going to start this from the basics, right? And the first thing I want you to do is I want you to you know, lose the stress. You're not here to become an accountant. You're not here to memorize all of this stuff. What Christy and I, you know, and IOOGO, what we're trying to do is we're trying to bring awareness to you and the things that you need to do to make sure that your company is heading in the right direction, whether you do it yourself or whether you employ the assistance of help, you know, to do tax and accounting for you. You need to be aware of a lot of these things. And as Christy said, we have an agenda. But the most important agenda is you. Whatever questions you have, if you want to drop those questions as we go ahead and do that. We don't want you to forget the question, and then later down the road, you were like, oh man, I should have asked the question, right? But I forgot. So go ahead and drop the question, and we'll address those questions as we go. And as I am talking, as Christy was explaining different things, if things come to mind that you want to answer, by all means, go ahead and do that, and answer, drop the question there in the comments. But let's talk about the basics, right? And I always start with, we all want to get to the next level, but we have to take care of the first level, level number one, and that is, the small things like bank accounts and records, right? And we, because we work with a lot of young startups every single day, we get to see what we all experienced. And that is, the lack of understanding, the lack of education that we have when it comes to financials for our companies. And you get to see companies who have personal bank accounts that are being used as business bank accounts, and very little record keeping, right? So one of the things that you want to do, and you want to build that habit now, is to ensure that you start making that separation of bank accounts and transactions. What's business is business, what's personal is personal, and you want to have those records, because those records are not just they're not just handy for tax purposes or accounting purposes. They're also they come in handy for you to make projections down the road, right, based on what you've spent. So bank account and records, right? One thing super important. The other thing that I like to mention to you is to be mindful of your deadlines and tax deadlines. We get to see a lot of founders going to year 2 or year 3 with a lot of tax issues, or a lot of tax filings that have not been filed, and that, what that does is it just gives unnecessary stress for you, because it's there, you have to take care of it. And the more you ignore it and the more you let it mount, the more stressful and the more costly it's going to get, right? So you're probably thinking right now, and you're probably saying, hey, but why do I have to do that, right? I'm not the accountant. I don't need to pay. Why do I need to pay attention to tax deadlines and things of that nature? Because any CEO, and whoever CEO you look up to, whether it's Elon Musk, whether it's Jeff Bezos, whether it's Mark Cuban, anyone who you look up to, I guarantee you they learn this stuff, right? Basic accounting, basic numbers in your business. It's going to have a profound impact on how you negotiate your rounds of investment, how you negotiate loans, how you increase revenue. And it starts with the little things. Another thing is, that you can see, is staying on top of your stock records. You can go as simple as a spreadsheet. Christy and I have built a lot of spreadsheets for different companies, for them to track their records, stock records. Or you can do the more traditional way now, which is using software like Carta, right? It's very inexpensive, and when you look at the benefit that it brings to you, because it all comes down to that time where you are about to get that term sheet, or you got the term sheet, but you need all these records, right? And those records aren't there, and they're not going to magically appear, right? So it's a habit, right, of taking care of everything that you're doing as a founder. And the more you do it now, the less painful it's going to be down the road. A lot of these reportings that you see here on the screen, they all come from the normal habit, or the normal process of doing your paying attention to your accounting, whether it is that you pay someone to do that, or that you do it yourself when you start. Then you start understanding these basic reports that you're going to have to provide to your investors, you're going to have to provide to the banks, you're going to have to create in order for you to look at the future of your business. One of the biggest mistakes that you can make, and I'm going to tell you this from the standpoint of an accountant and also from a founder of a company. From an accountant, I got to tell you, you need to know your numbers, because no one in this world knows exactly where you are headed to. What is the direction of your company? And if you don't know your numbers, you don't know your business. If you don't know your cost, you don't know your business, right? You don't know your margins if you don't know your cost, your potential profit, or anything, or things of that nature, right? So you have to sit down, as painful as it is, as boring as it sounds, you have to sit down and think about what is the cost, what is the potential profit, what are the margins. But it comes time to think about reports, and those reports, such as like the profit and loss report, is a simple report, especially for those of you who are already generating revenue. And even if you're not generating revenue, you want to see what you're spending on a monthly basis, right? If you're a very small company right now and you have less than $10,000 in revenue, then you should sit down in 15 minutes per week and go through your numbers and see what you're spending, and see what your opportunities are. But this is a very simple report here that just tells you what's coming in, what's going out, and what your potential profit or your potential loss is. And these reports are necessary whenever you are in the process of raising capital. Every investor is different. Some investors don't care for this report. Some investors do care for this report, depending on the stage that you're in. There's also the balance sheet report for those of you who are more mature now. And the balance sheet report simply says, hey, this is how much you have in assets. This is how much you as a company have in liabilities. So, to use a simple term of liabilities, it's the money that the company owes, right? So assets, it's all the goods and services, all the money that you're owed. Liabilities, all the money that you owe, right? So it comes down to a balance, right? What is the worth of your company? So very simple things here on this report. And some of you may never have to worry about this just because of the nature of your business. Most of you will have to worry about this. And two statements that I'm not going to go into too much details that you need to know is the cash flow statement. You need to know how much cash you have in hand. What I call it is, this is the statement is the cash flow statement is the statement that keeps you honest, because it tells you exactly how much cash you have in hand and when you can potentially run out of cash. And one that you're going to be talking a lot about, if you are building your business, or you're going to be building that business for a few years and you're not going to be turning a profit, the burn rate. This is a very simple calculation that a lot of your investors are going to want to know. What is your burn rate now? What's your burn rate is going to look like 6 months from now? What is it going to look like after we give you money, right? So this report right here, these 4 reports are what I call the basic reports of any startup founder. You need to know, you need to understand this. So if you want to know more about those reports, if you have questions about those reports, if you're doing those reports already and you probably have doubts, feel free to reach out to us and we can help you out with it. But this is basically the base. This is what we call the basics of any company.
So kind of carrying that forward, you have to figure out at what points am I doing it myself, or what point am I engaging someone to help me? So when you're first starting out, you need to do it yourself. Just like Josh said, if you don't know your numbers, you don't know your business. And the only way to know your numbers is at the beginning, to get down and dirty with them. So we always recommend for any startup to do it themselves, especially if you're pre-revenue. But eventually you're going to grow. Things are going to get a bit busier and you're going to need some help. And you may not be at the point where you can 100% hand it off, but you can find an accounting partner that, you're working on it 50-50 together. And then finally, when that business really takes off and you really just don't have time, you're too busy focusing on the growth, on the operations, then it's time to go ahead and let an accounting firm handle it. But when you hand it off, don't just hand it off and close your eyes. You want to find an accounting firm that's going to still be engaged with you at least on a monthly basis, because nothing is worse to a business owner finding out at the end of the year what their numbers look like and getting a huge tax bill.
I think one of the important points to understand here is, you did not open your business to become an accountant. So, but because funds are limited at the beginning, because over all the different situations, you do want to sit down and start understanding what your numbers are. No one is going to care about your numbers more than you. So it's important that you begin to you understand this progression, right? Now, this is not a black and white one size fits all situation. We work on a weekly basis with startups who, from day one, the founders, it says, hey, I have $500,000 in the bank. I don't want to deal with accounting. And, here we go. I'm going to worry about growing my business, launching my business, and you guys worry about accounting. Okay, that's a whole different situation. But when you are, in the process of raising capital and you are the one paying for everything, then that makes things more complicated, right? So, but again, it all comes down to, you don't want to be the disengaged founder or CEO who just doesn't know numbers. And then, anytime you go to an investor meeting, oh, well, the accountant, anytime you go to a bank, you don't know what the numbers, you don't know what your profits are, right? You cannot grow a business that way.
So as I said earlier, with growth, comes usually payroll for yourself or employees, and with payroll comes taxes. And there's some things to consider when you're hiring someone for your business. You can hire them as an employee, or you can hire them as a contractor, and depending on how you pay them, there are tax implications or lack thereof. So if you hire an employee, you have an agreement to pay that employee X amount per year. But as their employer, on top of what you pay for their salary, you also have to pay 7.65% in Social Security and Medicare wages. So that is an additional expense that you have when you hire someone as an employee. When you hire someone as a contractor and you have an agreement to pay them for a project or for their time, you pay them that amount and that's it. And it's up to them to pay taxes for what you have paid them. Josh, did you want to add anything here about employee or contract versus contractor?
I think that the only thing is that you want to be careful on who you name and who you call a contractor, right? Because, most states have very, very tough laws when it comes to labor, and you don't want to call someone a contractor just because you don't want to assume the employer taxes. That's inevitable. You want to grow your business to be the next Amazon. Well, you got to do the right things, right, to get there, and that is paying taxes, contributing taxes, and as an employer. So you want to be really careful, because one of the things that we've seen in our experiences, that year 3, year 4, you have all of these contractors that are now employees, and now there's a potential Department of Labor or Texas Workforce Commission audit, that's saying, hey, no, this is these aren't contractors, are employees, right? And vice versa. Or you also don't want to get into too happy hiring people when you don't have the right level of funds, right? Because you got to pay the employees, right? So I think this is where you start thinking and start getting the advice of an accountant that can guide you in the right direction, and you just want to make sure that you don't go into that situation where whatever you save today is going to cost you 10 times more later.
Okay. And so, very good point, Sarah. So you just definitely want to consider whoever you're paying. If you're paying them as a contractor, really making sure they're truly a contractor and not an employee that you're trying to not pay payroll taxes. But with those payroll taxes, as you pay that employee, if it's biweekly, weekly, monthly, you're also needing to make that deposit into the IRS for those payroll taxes. And that should be done pretty much at the time that you run payroll. And hopefully you have an accountant or a payroll service that's handling that for you. But on a quarterly basis, you're making those payments and you're building up to this report that has to be submitted quarterly. So we're coming at the end of Q1. And so this report should be built for January, February, March. And then in April, it'll be due. And basically you're telling the IRS, these are the number of employees I had. This is how much I paid them in total. These were the taxes they told me to withhold from their check. And then their Social Security and Medicare taxes that get calculated. And so this form says, okay, well, you should have deposited this amount of money. And if not, you have to do at least on a quarterly basis. And so whatever you deposited needs to match this form. So this is more of like letting the IRS know what happened for that quarter. And then on the state level, so then there's also unemployment taxes that you have to consider. And although the federal government wants to know about payroll taxes quarterly, they only are concerned about unemployment on an annual basis. And that's because the numbers are usually lower for unemployment taxes for federal. So at the end of the year, you're filing Form 940, telling them very similar information that you told them in Form 941, but there's just different calculations. And like I said, this is annual for most businesses. It does become more frequent obligation if you're a really large company that is paying millions of dollars in salaries. Then they want that. The IRS wants that more frequently, so they're making sure they get paid more frequently. So that's the Form 940 for the federal unemployment taxes. But then at the state level, there's also unemployment taxes that you have to pay, and that is at the quarterly level or quarterly time frame. So again, at the end of every quarter, you need to log into the state workforce commission, let them know not only how many employees you had, who are those employees, and then how much did you pay each of those employees. They'll also calculate how much you have to pay in state unemployment taxes, and you'll have to make that payment. The deadlines are the 15th of the following month after that quarter, so it's important that you do it pretty quickly after the quarter ends.
So to give you an example, right, if this quarter that's ending in March, January, March, April, the State Department and the federal the IRS, right, is looking for a report of that quarter. So when you start hiring employees, things get a little more interesting, and you can no longer get away with what you used to when you were just a one-man band, right? There's more paperwork, there's more requirements, and there's a lot of things that you have to have under consideration. Hiring an employee is not just the salary that you pay that employee. As Christy mentioned, there's all sorts of taxes, and then on top of that, that's of course totally up to you as the CEO. Benefits, right? So, and all those benefits will cost a lot of money. So this is why I always tell people, before you hire employees, make sure that you have forecasted enough resources for you to not fail that employee, and also not fail the federal and state governments. But let's move on to the other taxes, right? Because when you open a company, you think of all the challenges you're going to have. You think of a lot of us think about raising capital. A lot of us have issues with goals when it comes to development software and brands and things of that nature. And then later down the road, we start thinking and we start learning that it's not just one tax report that I have to do. There are several reports that I have to do throughout the year, and all of a sudden, finding or founding a company, becomes a little more complicated, right? Because you have all of these taxes now, and most of us, are probably not going to have to pay taxes throughout the first years, just because we're losing money. Or we're not generating revenue, and therefore, there's no, taxes to pay. But what we do have is the responsibility to file these reports. So I'm going to go through some of these reports with you, reminding you that none of this is for you to, stress, or for you to get worried that, oh my God, I got to do all this myself, No, this isn't a tax class. What I'm trying to do is I want to bring awareness to you of all the things that, or how much fun your life is going to get as you grow as a company, right? But the first point is, that your legal entity, your legal structure really determines what tax return you're going to file and what responsibilities you're going to have for the state and the federal agencies. So to give you an idea, Form 1120 is the form that most corporations are going to file. If you're raising capital, more likely you filed, you incorporated in the state of Delaware or in the state of Texas as a corporation. And that is, this is a very complex form to file, because not only are we talking about the accounting, the yearly accounting for the company, we're talking about, balance sheets, we're talking about all sorts of different tax situations, and sometimes benefits, right? Tax credits, tax deductions that we are going to incorporate into these forms. But it's the form that you're going to be sending to the IRS, and more likely you're also going to be sending this form to investors, or you're going to be sending this form to some of your banking relationships, right? That you have. So it's very important that it's that everything is represented there, right? The growth of your company is represented on legal documents like the Form 1124 corporations. One last thing to say about this is the due date. Your due date for a corporation, for the federal government, for the IRS, is April 15th. So we have some time, right? But if you are an LLC, if you file in the state of Texas as an LLC, or you're registered as an LLC, more likely, you also became an S corporation for the IRS. We're not going to get into all the details. We actually have another webinar that we can share with you, so you can learn the differences between all of these situations, right? But if you're an LLC, more likely you're going to be filing your taxes on Form 1120S. This is what typically happens. Sometimes it's very, very, very it varies very little, but most LLCs are going to file their taxes on 1120S. This is what we call pass-through income. What that means is that whatever profit or loss the company has is going to be passed through your income tax return, your personal income tax return. Sometimes it's good, sometimes it's not good, right? So for the most part, it's good. So you're let's say that this company, this LLC, had a profit of $50,000. Well, those $50,000 are going to then be carried through or passed through the owner of the LLC or the owners of the LLC, and you're going to, instead of paying corporate tax, you're going to pay what we call marginal tax, right? That's what everybody, everyone who's not a company pays, and that's a good thing, right? I much rather pay, marginal tax. I much rather pay, normal tax than have to pay corporate tax, because corporate tax can be a little more expensive, right? So, but it's important to know the deadline, March 15th. So here in the next 11 days, you have to have this in. You got to have this report done. And before we can make the tax return for you, before anyone can make the tax return, you got to have your accounting ready. And 1065 it's really used for informal partnerships, not very used in our world, in our in the world of technology firms. It's 1065. Basically, two people say, hey, we want to become a partnership, and then we want to file our taxes at the end of the year, so we'll use 1065. There are some limitations here as to what you can do. So my suggestion is, if you have not incorporated yet, if you're listening to me and you are a self-employed individual, my suggestion to you is that you consult with an expert like myself, Christy, or any other expert you feel comfortable with, about what is your, what you should do when it comes to incorporating your company, because your plans, it's what's going to determine what you do, right? And what plans do you have? Do you have plans to raise capital? Do you have plans to sell this business in the next 2 to 3 years? What are your plans? That's what's going to determine, which entity you should incorporate under. And if we look at the state, if we go back, Christy, and then we go and we look at the state regulations and the state requirements, most of us here in Texas, to give you an idea, IOOGO is a Delaware company, but we are based off Dallas, Texas. We love Texas. We're Texas proud. So what does that mean? It means that the state of Texas wants us to also be registered here as a foreign corporation. Yes, we are we incorporated in Delaware for, different reasons, right? We are a corporation. We raised capital. We did all that stuff. And, but the Texas says, okay, that's really cool. But you work here, you operate out of here, so you have to file, for a foreign entity registration, which means that at the end of or once a year, you're going to have to file a foreign entity report, a franchise tax report. You're going to also have to file a Delaware franchise tax report if you were registered there. So let's talk about the franchise tax report there for a minute. Actually, the franchise tax report is a simple report for to do. It's and the one thing you need to know as an entrepreneur, as a founder, is when do I have to file this report? Well, typically we file the report by May 15th. The deadline for this year only is June 15th. So we got an extra month because of everything that happened to Texas a few weeks ago.
Right.
Now, you need to understand this. Whether you have zero income or you have $1 in income, or, whether you consider it important or not important, you need to file this report, because this report allows you to tell the state government, right, this government of Texas, that you are still alive, that you are living, you're still kicking, right? You may not have revenue, but you need to file the report. What happens is, if you don't file the report, in a matter of weeks or months after you don't file the report, they're sending you a forfeit of your business registration, and you don't want that to happen, right? So there is a threshold here, because we talk about franchise tax. I want you to think of that, franchise tax. And we hear the word tax and we get scared, and we're like, oh my God, I have to pay taxes. No, there is a threshold here. If you are under the $1.1 million threshold, then you don't have to pay franchise tax, but you have to file the report. Now we go to the Delaware tax, and that one's a fun one, because the Delaware tax is the one that gives you a heart attack every year. If you haven't gone through this, it's going to happen to you, I guarantee you, because as soon as you log in to the Delaware Department of Revenue, you're going to see this astronomical number. We can barely see it here, but the franchise tax that they're requiring for this company is $27,377.79, right? Do not go and close your company and go file for bankruptcy when you see that. Okay, that's this is how the report opens. We enter the right numbers there, or you enter the right numbers in there. You fill out the report, and it more likely will come down to the minimum tax that you have to pay, which is $400, right? So you have to give the Delaware Department of Revenue some information about your stocks and what you've done with the stock throughout the year, and then the actual number will come up, the actual tax number. But for most of us who were in year 1, year 2, year 3, and there was not very many changes on the stock in our company, then there's typically the fee is a $400 fee. You cannot escape the $400 fee. So that's something you need to understand. If you have not incorporated yet, you need to understand that if you are going to incorporate in Delaware, you're going to get hit every year with a $400 fee at a minimum, right? Very similar to California. Whenever you incorporate in California, you're going to get hit with the franchise tax fee of a minimum of $800. There's no escaping that. So here's where I want to say, the last thing I want to say about the Delaware tax. Don't do it yourself. Get some help to do this, because what you're telling Delaware is a continuation of things, right? This is what happened this year. This is what happened, the year before. And you want to make sure that you're building this report right, because the last thing you want to do is you don't want to find yourself with 4, 5, 6 years of wrong reporting, or you're just paying money in taxes that you're not supposed to pay just because you're trying to save yourself $100, $200 in a reporting fee or something like that. So, all right, what did I miss? Estimated taxes, very important. The last topic I'm going to cover here: estimated taxes. As your business gets older, more mature, more experienced, as more revenue begins to come in, you will have the requirements from the IRS to start paying estimated taxes. Once the IRS begins to understand or finds out through tax returns that you are turning a profit, they're going to send you a letter saying, hey, why don't you start paying your taxes quarterly? So instead of, and I'm not talking about employment taxes. I'm talking about income taxes. Then there's where things get a little more exciting for you, because yes, the revenue is coming in and the government saying, hey, we don't want to wait for you until the end of the year. Send us that money now. The point that you need to understand is the benefit of estimated taxes. If you are doing quarterly estimated taxes, what's going to happen is that you're not going to have a surprise at the end of the year on how much taxes you owe. The whole thing that we all grew up with, we let tax and accounting become a once a year type of situation, and then we get this surprise. Well, if you are doing estimated taxes, quarterly taxes, you're not going to have a surprise at the end of the year. As a matter of fact, we here at IOOGO, we don't like surprises, when it comes to taxes. October, November, December, we're going to start talking about what your taxes are going to look like, so there are no surprises.
Yep. All right, we talked a lot about taxes and money coming out. Let's talk about how we can save some of those taxes and reduce that liability, because paying taxes definitely isn't fun. So the first thing I want to go through is talking about all the different credits that you can take advantage of. And the first one, which is the most popular one, especially with capital factory companies, is the R&D tax credit. And if you haven't heard of the R&D tax credit, it's a government incentive for businesses in industries like technology, science, medical, anything like that that's working on anything innovative, and rewarding them for that work. And so any money that you're spending on research and development can be used in this credit. So there's a process where there's a big, long case study that has to be put together. It's very detailed, in depth. It's something that the IRS requires. That's something our team helps our clients put together. And then because we have access to our clients' accounting, we can easily identify all of those expenses that qualify. We have access to their payroll, so the audit is part of that process. And we get all those numbers together, crunch them up, and figure out what that credit is. And then the best part is being able to take advantage of the credit. So you can take advantage of it one of two ways. You can either, if your business is profitable, you're a C Corp, you've got corporate income taxes that you have to pay, you can basically take that credit and say, instead of paying all of those taxes, I'm going to use my $10,000 credit and cover a portion of those taxes or all of those taxes. But if you're a company like most startups that are not yet profitable, the most popular way of using this credit is against payroll taxes. So like I mentioned earlier, you are responsible for 7.65% of whatever you pay your employees. So instead of paying that, you can say, Mr. IRS, I've got this $10,000 credit and I owe you $7,000. So I'm going to go ahead and put $7,000 of my credit towards those payroll taxes. So now you get to keep that $7,000 in your bank account, use it for operations, use it to grow your business instead of paying for additional taxes. And then a couple other taxes or credits that you can take advantage of for 2020 and 2021 so far, they're both COVID related, is the employee retention credit. So that same payroll tax I've been talking about, struggling with your income because of COVID related reasons, you can ask the IRS to allow you not to pay those taxes right now. And therefore that's money to keep your business going and to continue to pay your employees, hence it being called the employee retention credit. And then lastly is the sick and family leave credit. And that is also money that the government is giving to businesses to cover if you have employees that could not work because either they were sick with COVID or they had to take care of family members that were sick with COVID. That was lost productivity for you, but you still had to pay them. So the government's saying, okay, they didn't get to work for you, but here's some money to help pay for their time, even though they weren't there.
Yeah,
So those
so
are
really,
credit.
really important credits that, the way I look at it, as a founder of a company, and, this is my third company. I've always looked for those credits and those deductions that can legally help me reduce my tax liability. The more money I can keep, the best. The more employees I can have, the more, the more I can pay them, the better vacations Christy can take, right? So, um, the idea of just paying taxes, right? It's not a bad thing, but it's, so I don't want you to walk away from here thinking, oh my God, taxes are, a bad. No, what you need to understand, when you start paying taxes as a company, it's good, right? Because that means you're profiting, right? But you can regulate, you can reduce the amount of taxes that you pay by taking advantage of some of these credits and deductions. But what you have to understand is that all of this has to do with the IRS, federal agencies, state agencies. So it takes time to put together, right? It's not just a simple click of a button, magical situation. So this is where accounting is very important, because all of these credits, all of these deductions are actually built through the process of accounting, so that at the end of the year can be reported in the right forms. And the most important part, you can prove that you can qualify for the credits. Same with the deductions, right? Keeping a good record of your startup cost for you to understand what that is, right? The startup cost is the amount of money that you spend prior to opening the business. But you're saying, well, I opened the business the first day I started spending money. No, that's not how the IRS understands this. Your startup cost is the money that you spent in preparation to opening the business. The IRS considers you an open business the day that you bring the first dollar into the business, right? So it's, the startup cost is very important, because we're going to be able to report that in your income tax returns after you have generated revenue. So depreciation, something that sometimes is very overlooked. You can depreciate a lot of the assets that you have in your company, like laptops, phones, desks, and depending on your company, that's how valuable the depreciation deduction is going to be. And also, one we don't have here is called amortization, right? That's when you can do some of the deductions on patents and intellectual property and things of that nature that go into effect, right? 'Cause you're paying for that, right? So they're going to give you a benefit at the end of the year, sometimes for many years to come. The next two deductions are more for you guys who are self-employed or who are LLCs, right? You have the QBI deduction, the qualified business income deduction, that automatically reduces the amount of taxes that you have to pay by 20%. This is a complicated calculation, but it's worth taking. Also, the employee benefits. A lot of self-employed, for lack of education, lack of understanding of how this works, they pay for this out of pocket instead of incorporating and letting their companies pay for this employee benefits, and then reporting that as a deduction, right? So finding the right ways, and this is where you have to talk to someone that you feel comfortable with, finding the right ways, finding the good those benefits for you, for your company, for yourself, that are going to have an impact in your bottom line, right, in your cash flow. And the last one, I'll mention is the carryover losses, right? And that is something that it's something you're probably not going to take advantage of on the first year or two, but you will, once you start generating profits. And once you start generating good, amounts of revenue, and you have a profit, because now all of the losses that I have in year one and year two, now that I am making a profit in year three, I can bring some of those losses and offset some of the taxes I owe. So this is why it's so important for you to know the high level, for you to be aware of this. Do you have to dominate every single one of these credits and deductions and terms and all of this? No, that's not your job. That's not why you open your business. But you have to be aware that they exist so that you don't leave money on the table or that you don't set up your business on shaky ground.
All right. Hey, Josh, before we move on, can you share the example of how Amazon took advantage of carryover losses?
Yeah, so we always hear the example, right? Or we always hear this the soundbite on the news that Amazon doesn't pay taxes. Amazon doesn't pay taxes. Well, that's not necessarily true, right? Amazon pays a lot of local taxes. They pay a lot of payroll taxes. But Amazon, most of us know this. They lost money, year after year after year after year for a long time, and they were able to carry over a lot of their losses, to the years when they did make a profit, and therefore, they found themselves in a very cool situation where they didn't have to pay income tax, and they're a technology company, so I guarantee you they also took advantage of the R&D credit and other deductions that are available to them that are also available to you. You just got to do the work, to one, either find the right accountant that can help you and put you in the right direction. Two, sit down and start looking at how those deductions work and what they how can they impact your business.
Yep. All right, so as promised, we're going to leave you with some resources. We covered a lot of topics, but each one of those topics can be a very lengthy discussion itself, and we recognize that everyone has their very unique situation, and we can't cover every unique situation. So we want to let you know that if you want to have a free 30-minute accounting consultation, please feel free to schedule some time with one of our professionals, or me and Josh, and we will be happy to help you with any of your accounting questions. Same for tax questions as well. We have a separate link there. And then, Josh, you want to talk about, and then also there's, we highly recommend that if you need help from a lawyer for your startup, Kyle Kurtz is, a friend of ours that we always like to promote because he provides such good work. Everyone speaks highly of him. The business is Jones Kurtz, so there's their website. And please, if you need more tips for the future, follow us on social media. We're putting stuff out there daily. So you don't necessarily have to schedule meetings with us if you want to learn more. We're always putting it out there for free for startups and small businesses.
Cool. Well, thank you so much.
Yeah.
We'll hang out here if there are any questions or anything that you want to share with us. We'll hang out here for a few minutes. If not, thank you for being here. Always appreciative. If you're going to watch this on the recording session, then feel free to reach out to us after you finish the webinar.
Yes. Sorry, it is going to be available on YouTube, so we'll make sure that everyone gets that link. All right. Thanks, y'all.